Amazing, we are live. But as usual, we'll probably just wait a good like half a minute or so as people trickle in, and then we shall get started. We have a very exciting event for you today. In the meantime, if you're joining in, please feel free to introduce yourself in the chat, say hello, where you're tuning in from, and be sure to switch the message to all attendees so that everyone can see it. Otherwise, it'll be literally just me and Alex seeing your messages, which is also fine. Right. Well, I think we can get started as more and more people trickle in. So, hello, Finimizers, and welcome to another Finimize Live. My name is Reda, head of content here at Finimize, and I am absolutely delighted to host today's event on the new rules of investing with our partner, Free Trade. Now, first, just a few housekeeping rules, and then we'll get started. So, first of all, like I said, please feel free to introduce yourself in the chat. Where you're tuning in from, and remember to switch the message to all attendees. Second of all, in terms of format, this is going to be a 15-minute discussion with our guest, followed by a 15-minute audience Q&A, which takes me to my third and final point. Please use the Q&A box down below in Zoom to ask a question. You can ask anything you want, and if you see a question that you like, upvote it so that it moves to the top. That way, we can go through the most upvoted questions first. Now, without further ado, let's get started. So like I said, today's session is brought to you in partnership with Free Trade. Now, if you're not familiar with Free Trade, they are an award-winning, commission-free investment platform giving UK investors access to global markets. So investors can choose from a general investment account, an ISA, a SIP, SIPP, and access over 6,000 UK, US, and European stocks, ETFs, investment trusts, government bonds, and mutual funds, and a lot more. Now, of course, no finance event is complete without a very quick disclaimer. So, as always, please note that your capital is a risk, and nothing we're discussing here is financial advice. Your tax treatment depends on your own individual circumstances, and of course, may be subject to change. Now, with that out of the way, I'm really pleased to introduce today's guest, Alex Campbell, Director of External Affairs at Free Trade. So Alex is the Director of External Affairs at Free Trade, where he champions the interests of retail investors through media, investor education, and with policymakers. Alex regularly contributes to national and international press on personal finance and investing trends. Before entering the world of investing, he completed a PhD in history at the University of Cambridge. Absolutely fascinating. Alex, it's a real pleasure to have you with us. How are you doing today?
I'm great. How are you?
Fantastic. Yeah, really excited for today's event. But before we dive in, just to kind of understand, I guess, the audience a little bit, we have a poll that's going to pop up on your screen, which is basically asking how many funds do you hold in your portfolio, and we will take a look at the results before the audience Q&A. So if you have a moment, just answer that poll, and we'll see what people are doing. But without further ado, Alex, I really want to dive into some questions. Really want to pick your brain on some investing topics. And so in the introduction earlier, when I was talking about Free Trade, I mentioned obviously that you guys offer ISAs, which is very unique and I'd say beneficial, right? Investment accounts in the UK. And just perhaps, for the sake of everyone, what are some of the biggest advantages and disadvantages of using an ISA for your investments?
Thanks. Yeah, the ISAs, I don't know, we're pretty lucky in the UK to have something like an ISA. So this is a special type of account that's been around for quite a number of years now. It's gone through a bunch of changes. You can invest or put in up to £20,000 per year across different types of ISAs. So you've got your cash ISA, you've got your stocks and shares ISA. There's some more niche ones like a lifetime ISA or a LISA. There's an innovative ISA. Basically, what it means for your standard fare stocks and shares ISA, any investments you make in there, the income you get from them, the capital gains, that's not going to be charged any additional tax. So it's a tax efficient way to put your money to work.
Amazing. And any particular disadvantages that stand out, to you? What about, selection? Are you able to invest in almost anything in these ISAs, or no, is it a bit more restricted?
Yeah, yeah. So I think a couple of things that's good for people to watch out for. The ISA rules do lay out certain things that you can and can't hold within an ISA. Now, it's not down to you as the investor to figure that out. It's down to platforms like us to make sure that we get that right. But it does mean that sometimes, if you're looking for a stock that's listed overseas or maybe a mutual fund, it might not meet the criteria for reasons that might not be immediately apparent. So there are some restrictions there. Another one that's sort of a quirk of how the ISA rules were created is you can only hold pound sterling in the account. So if you want to be buying or selling any investments that trade in a foreign currency, you're going to be paying for that usually a foreign currency conversion fee that your broker will charge. So that's something to watch out for. And I guess the final thing, some ISA providers, but not all, offer what's called a flexible ISA. So I said you've got this £20,000 a year allowance. Basically, that means you can put the £20,000 in. If your ISA is flexible, say I take out £5,000 because I've got to pay for some unexpected repairs to my house or whatever. If the ISA is flexible, I could put that £5,000 in. It wouldn't count against my annual allowance. But if the ISA isn't flexible, then and you've put in your £20,000, you take out five, you've already used up your £20,000 allowance. So that's something to keep in mind when you're looking at different providers is to check if it's flexible or not.
Definitely a few quirks to watch out for. You mentioned obviously investing in, mutual funds, and there's, correct me if I'm wrong, thousands of mutual funds out there. I'm very curious, Alex, what frameworks or criteria, you use or should investors use to basically avoid choice overload with all the different kind of options out there?
Yeah, it's really, really easy to get bogged down. Sometimes loads of investors get into their investing because they like the choice overload, but I think it's important to approach this with a bit of a framework in mind. So the most important thing from my perspective is you always start with your own situation. So think about why you're putting this money away, why you're investing this money, how long are you prepared to set this money aside for? If it's in an ISA, you've got that flexibility to withdraw it. But like if you're putting this into a pension of some sort, a self-invested pension, for instance, you won't be able to access that money until you reach sort of 57 years of age or you retire. So it's important to think about that time horizon, then also reflect on your own sort of risk appetite. So are you comfortable to sit back and, watch your investments go up and down with the market, or are you looking for something that's maybe a bit more steady, a bit more predictable? And use those sort of questions to get to yourself to a point, and you can use that to think about a broad allocation. So I would then think about broadly, if you've got, say, you're saving for 30 years, you're happy to take some extra risk because you got such a long time to invest, and you definitely don't need to touch this money. It's definitely not going to be needed for rainy day matters that crop up. Then you can sort of take that and dial up and down a broad asset allocation and think about, a portion going into stocks, equities, a portion going into bonds, fixed income, something that's a bit more consistent income, and then you might want another little portion in something that's private access assets or alternatives. There's a big push in the UK right now around these types of funds, although they're for particularly sophisticated investors. And take that sort of broader framework and then start to approach what funds are out there. Another way to think of this too, you can always look at like a core for your portfolio, a broad index fund, something that's going to track, the global stock market that's really low cost. And then you could have a satellite portion of the fund, so a core satellite approach where you get some funds that you can tilt your exposure to, themes or sectors that you think are really maybe they're interesting to you, maybe that you think they're going to be quite important in the years to come. So, if you want exposure to AI, then there's a number of different fund managers that might be running a strategy that would give you that sort of exposure. If you want exposure to the green energy transition, you could explore that.
Makes perfect sense. Thank you so much. And there's, a lot of focus when you read advice and, picking funds and so on, a lot of focus on costs, right? And this focus on keeping costs low, especially, to minimize the cost drag over the long run because of compounding. Now, curious to hear, so beyond the kind of headline annual management charge that you see advertised in every fund, what are some of the less visible costs, or should I say performance drags, that investors should be aware of when investing in funds or ETFs for that matter?
Yeah, so I think look, when it comes to investing, there's sort of a famous saying or that a paraphrase where the only two things you can control are the costs, the fees you pay, and the time that you're in the market. Everything else is an unknown. That's part of the joy and the frustration with investing. I think when it comes to costs, you've got to watch for the different levels. So your fund manager, whoever, if it's BlackRock or if it's Aberdeen or if whoever is the fund manager, they will charge some sort of fee. But then typically you hold these funds, if you're a retail investor in the UK, you're going to hold them through a platform. So free trade or one of the other execution only platforms, or maybe it's through a workplace pension provider. And typically those platforms will also charge some sort of fee for the service that they provide to buy and sell these funds. Now, oftentimes these are charged as a percentage of the amount you've got invested in that fund. And obviously, that means as your investment grows, you start paying more money. So you're paying 0.1 of a percent. As it grows, that 0.1 of a percent gets a little bit bigger and a little bit bigger. With free trade, we've done this in a different way where you're just charged a fixed subscription fee so that you don't have your fund fee or your platform fees growing as your portfolio is growing. We think this is probably we like this way to offer funds.
Amazing. Thank you very much. And sticking a little bit with mutual funds and mutual funds. So in what ways do mutual funds, in your opinion, still provide advantages over, let's say, ETFs or direct stock picking in today's market?
So I think there's two key things here. Mutual funds can cater to a bit more of the type of investor who wants a bit more of a hands-off approach, who might be time pressed, who's really keen to invest, but also wants to, delegate the actual work of picking individual stocks or bonds or whatever to a professional. In the UK market, I think mutual funds has a particular appeal because there's so much choice. The ETFs that are available to UK investors are still reasonably limited, I think, compared to the US, where recently there's more ETFs listed in the US than there are individual stocks now, I believe. So you've got a lot more choice when it comes to funds. You can go to basically any market in the world, you can get any sort of strategy. And you can find sort of the one that fits you right. So I think those two things, choice and then the comfort of choosing those types of pros who are going to, take care of all the hard work, and you can kind of be a bit more hands off. I think those are the key perks.
Makes sense. Thank you very much, Alex. And I have one final question before we move on to audience Q&A. And remember, if you have any question you want to ask Alex, be sure to put it in the Q&A box, and we'll get to those in a minute. So last question, Alex, and perhaps an important one, which is basically, what's one mistake you often see new investors making when they build a portfolio, and how can they avoid it?
Yeah, so I think you either see investors go one of two ways. They have too many funds, and this goes to the poll that we asked. You either have too many funds in your portfolio or too many individual positions in your portfolio, or you have too few. There's a lot of research, and everybody can go on to Google afterwards or ask ChatGPT or something to dig into a bit of this. But diversification is known as like the only free lunch in finance. This is a way to, balance out your portfolio so that when one sector is going up, the other sector might be going down, and it's meant to even out over time. The problem is when you do too little, you won't get that benefit. If you do too much, you'll have a bit of end up having a bit of performance drag. With funds, it's particularly tricky because you could get funds where, you know, if you're thinking of a US index tracker and a technology giants fund and a AI fund, the top holding in every one of those might be a particularly large chip maker or something that listed in the US. So you end up getting three times the exposure to a particular company by just choosing three funds that look on the face of it a bit different. So that's the trickiest thing, is to try this, to hit this sweet spot between, and there's no rule of thumb, and this varies for everybody. And it will vary again based on the types of funds you're putting in there. But if you've got too few, too many, those are the two traps I see people falling into.
Makes sense. Thank you very much, Alex. So without further ado, I would like to move on to audience Q&A. We have quite a few in there, and of course, if you have anything, please feel free to add it as well. So first question is basically, are there any ISAs available with precious metals?
So yes, you can buy, this would have to be exchange traded, what are called exchange traded commodities. And I believe that some of these there will be London listed, will be ISA eligible. So these are going to be I think there's a few fund managers that offer these. They track in one way or the other the spot price of gold, of platinum, palladium, silver, and these, I believe, are ISA eligible investments.
Makes sense. So basically, an ETF tracking, be it gold or silver. Another question, thoughts on investing in both the S&P 500 and an all-world fund?
Yeah, so I think this is a good, this goes to where sometimes owning two funds might give you a lot more duplication in the actual stocks you're holding underneath the bond, when you dig underneath the bonnet a little bit. So the all world fund, last I checked, I believe about 65% of the most all world indices are US stocks. So when you're buying an all world ETF or something, index tracker, you are getting largely US exposure because the US stock market is the biggest in the world. It's the source of loads of dominant companies. So just be cautious. There's pros and cons. You could have both, but this is where you can get a lot of overlap. I guess most of the S&P 500 will be held by an all world index.
Makes sense. Thank you. Another question is, how will the latest rule changes for ISAs impact individuals looking to maximize annual tax-free allowances?
Can I ask which rule changes in particular would you be thinking about? Because I know there's been a lot of talk recently. I'm not sure how easy it's going to be to get a follow-up on that, but there's been a lot of talk about changes to pension rules around pensions, around inheritance tax and things. The annual tax-free allowance has stayed the same at £20,000 for the ISA since it's been for a number of years now. That's been at £20,000. We've had a recent tweak where a certain type of fund is going to be permitted, called a long-term asset fund, from April next year. And we also had a big change where fractional shares were acknowledged as an ISA eligible investment, but that came into effect earlier this year. So Camille, if you've got a clarification, please shout.
Yeah, maybe you can put it kind of in the chat, perhaps, if you were referring to a specific rule change. And I'm sure Alex will be happy to answer that. In the meantime, we can move on to the next question, which is basically accurately pay for broker fees. Are these in addition to the charges for each ETF or fund? How are these usually charged and where do I find them?
Um, yeah, so typically if you go to a platform, like if you go to free trade or something, or another platform and you go to buy a fund or an ETF, you will get a little trade confirmation ticket, which will show you, and it should show you the costs for the transaction. So you might pay, your broker might charge you a fee of, say, £5 or something to buy a share or to buy a fund or an ETF. These vary. These are fees that are typically charged by the broker and will come out of the amount of money that you put into the transaction. ETFs and funds typically take fees in in two different ways, and it's a bit more convoluted. But the thing to focus on is in a key information document, you can see it will share what for an ETF or a fund. What sort of the ongoing management charge is, and then you can compare it. It's more of an accurate comparison. So there's a couple levels of fees. Your brokers might have fees for accounts, for transactions, and then the fund manager itself will charge you some fees, and this will effectively come off of the return of the fund.
Makes sense. Thank you very much. And if you remember, Alex, actually, in our last question, we were talking about mistakes, and you were talking about overly diversifying and investing in too many funds. So actually, I just want to take a moment to see if we can get this popped up on our screens, the poll results of here you go.
Yeah,
You can see that.
less than four.
So the half of
Mhm.
the audience, less than 4, and then I
Mhm.
guess 10% more than 15, which is the point you were making earlier. Really interesting.
Yeah, and it goes to show, like, for one of the things with funds, one of the downsides of ETFs, I think, if we're talking about just different types of pooled investment vehicles, is that you can trade them like a stock daily. And if you're one that gets a bit queasy when you see the market go down or something, having the ability to buy and sell when that happens could be a downside for you. So a fund where typically dealing windows, it can be some funds, the dealing windows 7 days or even longer. It just gives you that extra bit of time and buffer to, cool off. You might watch when the market dips, it might come back quite quickly, and you think, you know what, let's just let cooler heads prevail.
Absolutely. Cool head is probably the biggest key to investing.
Yeah.
Um, so we've got one question on what are the benefits of investment trusts when compared with mutual funds?
So, investment trusts generally are a closed-ended sort of investment vehicle. So you'll see trusts it will usually trade either at a premium or a discount to the assets that they own. Trusts also have the ability to take a bit more leverage. So, oh gosh, sorry, I just hit my watch. So they can use leverage a bit more flexibly than mutual funds. They can also, I believe, retain a certain amount of their earnings that they sometimes pay out as income to shareholders. So this can be a good thing, when we have a dip in dividends. Trust can hold that back to make sure it remains consistent. So there's some slight differences. It's structural. I know some people love trust because they're exchange traded, they're relatively transparent, and things like buying if you're buying a trust that's at a 20% discount, conceptually, this feels like maybe an easier thing to get your head around. It's not always the case, and that's not always a given that 20%, that's a 20% return. That's never the case. Discounts exist for a reason, but they're a very popular vehicle in the UK market.
Makes sense. Thank you. And with your watch presumably on the floor, I will let you know when the time is up. Don't worry, we still have
Oh
a
no,
few
it was the SOS alarm I hit.
minutes. Okay.
I need rescuing.
So we have another question, which is in terms of ISA investing, is it safer to be invested across multiple providers or consolidate into a single provider?
Um, so I think part of what this might touch on is around the security of individual providers, the level of protection that the financial services, the FSCS, provides. I think ultimately it's down to the individual what they'd like to do. The important thing to point out with all brokers, not just free trade, but any broker in the UK, they hold your assets sort of in a what's called a non-trading company, a nominee company. This is meant to be bankrupt. It's structured in a way so it's separate from the trading entity. So if there's a bankruptcy or if a broker goes out of business, assets are meant to be protected. The FSCS protection is there to protect you if there's some loss related to your broker going out of business, as opposed to losses on investments. So if if you buy a stock and it goes down in value and your broker goes out of business, you won't be reimbursed for the stock going down in value, unfortunately. So it's up to the individual. I think we see some people wanting to actively diversify a little bit, especially when you're doing multiple family accounts and things like that. But to be honest, brokers in the UK these days are we've got sort of capital requirements and things like that that are monitored quite carefully. And so there's a robust sort of consumer protections in place.
Makes sense. Thank you very much. Then we have one question. For higher earners, are there specific advanced tactics for pairing ISAs with other tax wrappers like EIS or VCT schemes?
Oh gosh, I'm not a tax expert, Camille. So this might be beyond the scope of my expertise here. Look, some venture capital trusts, VCTs, I believe are ISA eligible, so you can hold them in there. EIS schemes, I believe there might be some interaction with the innovative ISA scheme in particular, but it's not something we offer. It's not something I'm familiar with. It's probably worth digging into that a bit more. But look, high earners, I think you've got an annual pension allowance that you're typically able to make a contribution towards, and that's always good because you get sort of tax back off of that. So if you're a higher additional rate taxpayer, you can claim the additional tax back. You have to typically fill that out fill out a form with HMRC on contributions. And then once you've used that up, you've got your ISA allowance, which is an added way to, invest after tax income without incurring further tax going forward.
Amazing, thank you. And perhaps for our last one, I'll consolidate two questions into one. First one is why should one choose free trade over a broker like Trading 212? And then secondly, is free trade available outside the UK?
So we're not available outside the UK, and we don't currently have any plans to offer the product outside the UK. And look, when it comes to choosing your broker, there's a lot of choice out in the market. It really comes down to what you're looking for. We've built a product and an offering that we want to tailor to folks who are thinking long term. They want a place where you can consolidate, your ISA, your SIP, your general investment account all in one place, and you might want to mix, funds in mutual funds into the mix of things. So look, there's a lot of choice out there, so always take a look at what you're looking for. And free trade may be it, free trade might not be it, but yeah.
Amazing. Thank you so much. I'm afraid that's all the time we have today. Thank you so much, Alex. On behalf of myself, Finimize, the Finimize community, honestly, thanks so much. This was really informative, really useful insights. So thank you so much for all of that. For everyone, as you leave the event today, a pop-up survey will appear on your screen. Please take a few minutes just to let us know what topics you're interested in hearing about at future events. Alex, thank you once again. Thank you everyone for joining us, and I look forward to seeing you all in the next one. Take care.